What's going on, everybody? Just give it a little bit more time, let people hop on, and then we'll get going on one of my favorite topics. Get going in about 2 or 3 minutes. All right, let's get going. How's it going, everyone? Share my screen. Sunday, appreciate everyone for coming on before the market opens, checking out this training on Fibonacci, and then I'm gonna do a little bit of harmonic pattern recognition. You know, Fibonacci is a tool I use every day when I trade, so this will be a good one. Hopefully we learn some stuff today. So I'm gonna stop sharing my screen. We're just gonna head over to the charts. Let me make sure I'm sharing, and I am. Okay. All right, so first and foremost, first question, what is Fibonacci and why we use it? So of course I'm gonna go over the tool, the retracement tool, but what are these numbers over here, right? So the Fibonacci is a sequence of numbers, okay? And what it is, it's basically how the numbers are found is by adding up the two numbers previous. So it starts like this, okay? These series of numbers, we'll just, let me make it a little bit bigger than that. Okay, it starts with 1. And when 1 plus 1, so 1 plus 1 is 2, right? 1 plus 2 is 3. So I'm adding the previous two numbers together. Okay, so 2 plus 3 is 5. 3 plus 5 is 8. Okay, and you go so on and so on. And that is considered the Fibonacci sequence numbers. Okay, so when you add 13 plus 21, you get 34. Okay, you add 21 plus 34, you get 55, and it goes so on and so on. Okay, all the way. The bigger the number, okay, the stronger the number apparently. But these are the numbers. Okay, pretty much the beginning numbers of the Fibonacci sequence, okay? And how we have figured out these golden ratios and all these other ratios over here are based off of these Fibonacci sequences. And the reason why we use the Fibonacci is because artists and architects have figured out that these ratios in life are beautiful. They're appealing to the eye, to human nature. So when we see a pullback to the 61.8, a pullback to the 38.2, you know, it's appeal. We want to get into that trade. It's human nature. And it is algorithmic as well into the market. So now let's look at really what fib levels are important and why, right? So we're going to look at these Fibonacci sequence numbers, and I'm going to kind of break it down why we use like the 38.2 or the 61, the 78, okay? So the 61.8 is considered that golden ratio. And I'm sure a lot of people have heard that. Golden ratio, okay? And it's because when you take these numbers, okay, up here, and you divide any of these two numbers consecutively next to each other, you'll get 61.8 or something very, very, very close to it. So check it. If you take 55, and if you want to get out your calculator, I guess I could get out mine on the screen, but 55 divided by 89 gives you 0.61797753. You know, if you do 89 divided by 144, it's going to give you this golden ratio. So on and so on and so on and so on and so on. Okay, all of them are going to give you that 61.8. Okay, now to find the 38.2, it's the alternating numbers. So if you take this divided by this, you're going to get 38.2. This divided by this, you're going to get 38.2. So these levels aren't just there because that's the percentage that it's being pulled back by. They're crazy Fibonacci ratio numbers when you're dividing and adding things up. You know, to get the 78.6, it's the square root of the 61.8. The 88.6 is the square root of the 78.6. So all these numbers really do mean something more than just percent pullbacks. And you know, the 1618 is the 61.8 divided by the 38.2. And so that's why we use that as a target. So, you know, I didn't write any of those down. I have this recorded, so you can go back and listen to those if you want to kind of know why these numbers are. It's not the most important thing when you're on the chart by any means. It's actually not important at all when you're on the chart. But I'm the type of person who likes to really know what I'm doing the whole time. So that's like the history behind, I would say, these numbers, okay? And okay, so let's get into the actual tool that we're looking at, okay? So I'm gonna delete this right now, and we're gonna look at an example. So what is the fib tool? And guys, if y'all have any questions, this is a live training, so go ahead and drop them in the chat. I have the chat open. I have everyone muted just so I can kind of go through this a little quicker. But if you have any questions, drop them in the chat, and I'll be looking at the chat, and I'll be going back and forth, being able to answer questions. But let's get into what is the fib retracement tool and how and when to use it. All right. So the fib tool, we're going to go over here to Trading View, and it's going to be on this area right here. It's going to look like this. If you've never used the this section that you're going to look for, it's going to have the pitchfork tool. That's the first one right here. But you go down here to fib retracement, and let's click that. So I'm just going to bring up the tool so we can kind of look and see what it is. What we're looking at right here is a measurement tool, basically a Fibonacci retracement measurement tool. And what you're going to be measuring when you use this tool is you're going to be measuring an impulse. So What do you use it for? You use it to measure an impulsive move, okay? You don't use it at any other time, or I mean, technically you can, but I was taught, you know, to use it on impulsive moves. That's how I trade. So, you know, it's really for the kind of the bigger moves and to measure how far the market's going to come back, okay? And so it's going to look something like this. The market will be in a range kind of, and then we'll see a big move to the upside. Okay. So then you bring out your fib and you take it from the, in this case, in a bullish impulse equals fib from low to high. Okay. So when you see a bullish impulse, you want to take that fib and you want to grab it from the lowest low to the highest high. Now, here's where some people are a little bit different. Some people play the wick, some people play the body. It really is up to the trader. But me, I play wick to wick. So I'm going to show some examples in the chart. And I'll just show y'all exactly how I draw it in the chart. But for now, I'm just going to keep drawing right here when we get these questions answered. All right, so yeah, a bullish impulse, we're going from the low to the high, and then we're pretty much waiting to draw it when the market turns around. So if the market doesn't turn around yet, we're not even going to look to get this tool out. But since that market started to turn around right here, we're going to fib it from low to high, and we're going to wait for it to come back into a certain specific fib area that lines up with structure, okay? The sell is going to be the exact opposite, right? So for a bearish impulse, say the market's doing something like this, and then it drops out, okay? And then it starts to turn around. You want to bring out the fib. You want to go from high to low on this. So a bullish impulse, right? We are going from low to high, but on a bearish impulse, let's make this bearish impulse, we're going to go from high to low. Okay. So we got our notes here. And like I said, you want to bring this tool out when you see that impulsive move. And it doesn't matter what time frame you're on. If you're a scalper and you see an impulse on the 1 freaking minute, I've been back testing the 2 minute with my friends, and we've been back testing 2 minute fibs, and they've been hitting. Like, not 100%, of course, nothing is 100%, but when you see an impulsive move, that's when you want to bring the fibs out, or the fib tool out. Okay. Now I'm going to go into the settings just so y'all can see which settings that I use. Okay, so right here we have, these are the main fibs that pretty much is going to come standard on your MT4 or your trading view. You're going to see the 38.2, you're going to see the 50, you're going to see the 61.8, the 78.6, and the 88.6. All right. Me personally, I only use these three. I basically use this zone. I add the 71 instead of the, it's just kind of not like a secret fib, but a fib that one of my mentors used to use that I got really used to. So these 3 Fibonacci levels are the 3 levels that I look at. So, and the reason why is I trade swing to swing. I'm not a huge swing trader. I'm more of an intraday swing trader, lower time frame swing trader. But whenever I'm taking a trade and I want to make sure, that the risk to reward is going to be really good. Now, if you take a trade off the 38.2, which is going to be down here, or even the 50, these levels are down here, your risk to reward is just not going to be as good unless you add more risk putting your stop loss over here. Me, like I said, I like to keep my stop loss above the impulse or below the impulse, depending which way it goes. So that's the reason why I don't even look for those levels. Price could very well respect those levels and drop, and I'll miss out on the trade. That's okay. But I do not use the 50 or the 38.2 personally. It just doesn't offer the best risk reward. And I look for these levels. And you can look at it like this as well. And let's give an example. Let's give an example on a bullish impulse. And this is just another way of looking at it. Everyone thinks differently in the chart, so I'm trying to add some value to everyone. Now, we all like new things. We all like to buy stuff. We all like to go to the mall and shop. Well, not necessarily. We could just buy it online these days. But here we go. You want to buy a new pair of shoes, right? Here's these new pair of shoes. They're hot right now. Boom. Everyone wants to buy them. The price is up, right? The price is up on these Jordans, these Yeezys, these freaking Nike, whatever, okay? And you're going to the store and you're like, oh, heck no, this is way too expensive right now. I'm not going to buy them until they are what? Half off, right? We want it half off. Okay, so you bring out the measuring tool and you measure it and you wait for it to get half off. That's it. It's just a simple measurement. Now price is half off. You said you wanted to buy these shoes, right? You said you wanted to buy them. Well, now you can buy them half off. Get into the market and go. That's the concept behind using the Fibonacci retracement. You are measuring a move that should give you another move. Okay. So that's just another way to kind of look at it. Now let's talk about extensions. What are extensions? These are the levels that you're looking at price to go to, right? So I just showed that example of the buy. Where's price going to go to next? So let's give another little example of an impulsive move, and that might be a little high. So let's bring it down here. Impulsive move, okay? And then the market starts to retrace. So we're going to bring out the fib. And this time, I'm going to bring in the extensions. Let's see, yeah, okay, boom. Okay, so you know me, I'm waiting for it to come down to the 61.8 at least. That's that golden ratio, right? Right here. I want it to come down to the 61.8. Usually, what I'm waiting for is it to line up with structure as well. And so you see you got this perfect zone sitting right here, right at the 61.8. Okay, and so I'm waiting for price to come down into that. And these are the extensions. Let's go into the settings. So I have the negative 61.8 and the negative 2.7. You can use the fib extension tool as well. They have a tool for that, or you can just put the negative of what you're looking for on that. And so when price comes into the 61.8, I'm looking for it to pretty much respect here and head into these fib extension levels. And those are my targets. So this kind of sets up into, so fib extensions, let's put for that. These are the targets. And I have the 0, 60, negative, let's see. The negative 61.8 is the, let's see, the TP2. So let me do the first one is the negative 2.7 and then the negative 61.8. So you look at it like TP1, TP2. And if you really want to look at it, you can do TP1 at the, back at the top, TP2, TP3, okay? So how I look at finding a trade setup with these, okay? And this is exactly what it would look like. the market would be in a range, or the market would be at a low, or the market would be at a spot where it hasn't necessarily moved a whole lot. And then we get a big impulsive move, okay? Once you get that move, you bring out your fib, you measure it, and then you look to see which Fibonacci level lines up with structure, okay? Now, if you want to, you can go ahead and play the 38.2. You can play the 50%. That's up to you. And I'll bring those back into the picture just so we can see them all. You can play these levels, but what I would do is I would wait for structure to line up with the Fibonacci level and use that level. So in this case, it would be the 61.8 lining up really well. What I do, I put limit orders at that fib level because a lot of times it's just a wick. And I wait for price to come down here. Let's get this stop loss a little bit where it's supposed to go. Okay, so I put that stop loss just below, I mean a pip or two below this impulsive move. And then I target my extension, okay? And that offers a 3-to-1 risk to reward from the 61.8 every single time. So that's why I look for the 61.8 also. It's a high probability setup. If price comes down into the 61.8 and shows rejection, we're looking for pretty much a measured move off of this 61.8 up to here. Okay, that's what that is supposed to really. That's supposed to happen after price comes down and respects that golden zone. So yeah, that's exactly what it looks like. It's the opposite when it's bearish, you know. But yeah, fibs are pretty. They're not easy, but once you learn them, they become very mechanical. You see an impulsive move, you bring this tool out, you measure it, and it becomes your own little indicator. These take profit levels. Some people will only use like the 61.8. They won't look at the 2.7. That's kind of like how I look at it really. I don't really care for the 2.7 that much, but that's how I was taught, and I wanted to teach all the same levels that I learned. But if we don't have any questions on the fibs, any questions on the fibs, I'd like to go over into the charts real quick and kind of show y'all some examples of what it would look like drawing it live. So I'll just have to come back to what are harmonics, how to spot them, and all this. Okay, so let's go to the charts over here, and let's go. I have a couple of them starred. So let's go to AU, and let's see here. Right. So on the daily, we can go to lower time frames as well, and we could show some other examples, but we have this swing high, and I'll draw it from this swing high to this swing low, okay? And you can see price came up into this area, and I'll just kind of box it off, the 61.71 area. And really what you'll see on my charts a lot is you'll see either a red or blue box, and that's going to be the fib level that I'm looking for price to come up to. And you can see once it came into here, we had a reaction. There was previous support, or yeah, support here, and then there was resistance here. So it was a very strong level, and it was also the 61.8. So when price got here, we ended up dropping. Also, this was close, very close to a harmonic pattern. So if it would have pulled up just a little bit higher, that would have been a perfect Gartley setup. And we'll get into those in a second. But harmonics and fibs are pretty much go hand in hand. Let's look at a setup inside this setup. So, excuse me. I'm going to highlight the 61.8 area where price rejected. And now let's go look into the 1 hour. Okay. So after we had an initial reaction down, That was pretty big. Initial reaction down. We had some other impulse moves that started to wave out, right? So let's measure these other impulses. So we have an impulse here, and price came up into the fib levels and dropped out into the extension. We have another impulse here, and if I bring it over, you can see price came up into these levels and dropped out again into the extension. So not only did it hit the important fib level on the higher time frame and drop, but on the lower time frame, you had multiple chances to get into it. Let's go look at USD CHF. This happened last week. And I wanted people to kind of, I put in the chat to kind of show me a chart of this. I wanted people to kind of show me what I saw. We had a couple people do that. So from low to high, we had price wick the 61.8 and make a move up. Now it hasn't finished the extension yet, but look where structure was. We had previous rejection here, and then when we broke through, we came back, retested it, and it would have been a limit order. It would have had to be a limit order, or else you wouldn't have gotten in it. And that's what I'm saying. Whenever you see the impulsive move and it comes back and it lines up with structure, that's a really good setup. Okay, and it happens over and over. You see this impulse down. We came back into these fib levels and we dropped. And I'm gonna go ahead and take off the fibs I don't use just so I'm not confusing anyone. Like I said, I wait for a higher discounted price. Meaning if I wanted to buy these shoes, right, I'm waiting for the 50% off. I'm cheap. I want it cheap if I'm gonna buy it, right? So let's look at another example. Gold, okay, gold last week. This was a good one. And in fact, I'm pretty sure this bigger impulse, if I bring it over right here, this bigger impulse respected these fib levels and we started to drop very nicely. So I said in the chat, if we wait on an impulsive move down in this level, higher time frames are gonna end up coming to the downside. But let's try to catch a lower time frame setup. So once it did make that fib drop, it made an impulsive move right here. Now, sometimes, this is a good example. So you fib the impulse. Sometimes it makes a deeper retracement than you want. Sometimes it wicks you out and then drops. But from high to low, because it's bearish, it came up and it still ended up falling through. Now we have another impulsive move right here. So we can take the fib from the high to the low, and I'll take it to this low. And here's the zones. It came into it, respected it, and fell. And it hasn't followed all the way through yet. You see it came up here again, rejected and fell. So these levels, they're very strong. You can see the support and resistance that was previously there right here. So when you bring that through, just very strong confirmation at the 71. Let's keep going. NASDAQ, this was called on last week as well. This impulse down. Now this isn't the biggest impulse, so this is more of a pattern trading fib, because if you look at the pattern right here, we had a head and shoulders. And for me, for a head and shoulders to complete, I need to see the right shoulder hit the 61.8 of the head. So what does that mean? You have to fib the top of the head to the bottom of the shoulder. And I'll extend it out. And it did. It hit the 61.8 perfectly. And that completed the right shoulder, and then we followed through. Okay. Sometimes what will happen is you'll get an impulsive move, so high to low, and it won't hit your fib level. It won't hit it. It'll get close to it, and it'll miss, and it'll extend down. That happens sometimes, and that's okay. But this bigger fib, we got a bigger impulse right here. This big drop down. We came and we wicked the 61 and then made a big move, big drop. So ton of examples. I could go on and on and on all these. And I know it's hindsight. I know I'm looking in the past and I'm finding these levels, but I mean, it's exactly word for word what I taught, what I was taught as well. Structure lining up with fibs. It's all day long. We have structure, okay, fib, and I know it kind of broke up a little bit, but then it ended up dropping, right? So, oh, here we are on the daily. I'm back here at EJ again. Cool. So I hope that made sense. Those are a ton of examples right there on, you know, how to draw them. You can go back and watch how I drew them. I know I was going kind of fast. I wanted to get through a couple examples, kind of recent examples of some nice fibs that happened. Now let's see if I can get this to go back to how it was, so we can look. That'll be amazing. Huh? If anyone's ever done training and done this before, oh cool. I'll be able to do it. All right. So we're back here at we're looking at harmonics now. Now harmonics, all harmonics are, what are harmonics? Let's do this. What are harmonics? They are fib ratio levels that line up to create a pattern. That's in a, I mean, I'm not looking at something and copying that down. In my head, if I had to say it to a 5-year-old, because that's, you want to break it down easy, that's what it is. They're fib ratio levels that line up to create a pattern. And that's why you have to learn fibs before you can really learn harmonics, in my opinion. Because if you don't know what a fib is, you're not really going to understand what you're really looking at for a harmonic pattern. Now, having a harmonic scanner is where it's really at, but if you don't have a scanner and you don't want to pay 50 to 100 bucks a month, or if you can't hack the internet like some of my dudes can to get any freaking thing they want, no names, then you're going to have to learn how to draw them on your own, or be able to at least figure out what you're drawing on your own. Now, there's, I think, 6 or 7 different harmonic patterns. What I did whenever I started to learn them is I focused on 1 or 2 at a time and learned those, and then it helped me learn them all, kind of. Now, I'm not going to go into every pattern. That's not what I'm doing today. I'm kind of going to go into just the basics, because if you can learn just this basic part of harmonics, it'll be a lot easier for you to go in on some flashcard type stuff and learn the different patterns. But if you learn this, what I'm going to teach you, it'll make that part a little bit easier. Okay, so what a harmonic is it's a complex pullback. When you see an impulsive move, that's the start of it, okay? You gotta wait for that. If there's no impulsive move, don't be trying to draw harmonics. You wanna wait for that impulse. Then you're gonna get an ABC wave. So you get an impulse and then an ABC. The ABC is the pullback. So you got the impulse and then an ABC move. When you see something like this, especially in a trending market, okay, if you see harmonic patterns in a trending market, that is the best way to trade them. The best way to trade the harmonic patterns in a trending market. I know a lot of people trade them reversals, like at the top of a 5 wave. That's another great way to trade it. But if it's not an extended market, you might be caught up just in a mess. So I would either trade them in trade them in a trending market, which would look like this. Let's bring out this arrow and I'll do the so the market will be going up, coming down, going up, right? It makes like a big move up, and then it'll come down, and it'll make like another move up, and then it'll come down right here. Well, some people see that as an M, but if this market has been like kind of trending for a while, this right here is a beautiful Gartley pattern. And we're likely going to see another move to the upside. And this was just a complex pullback. Okay, this happens a lot in crypto. It happened now. Forex markets, they trend. Don't get me wrong, but they also they use supply and demand a lot more. Meaning they kind of go up and down a little bit more. But when you see a move like this in a trending market, get ready. Okay. Now, how do you know if it's gonna be harmonic or not? How do you know if it's just not lines like in the air? Okay, this is what we're gonna get into now. So I want to show this picture. Let's see. Do I not have it set up? Okay. I guess I don't. Let me get my let me get this in seconds. There we go. I want to get a picture of these harmonic patterns out for us so we can all see them. Just so if you've never seen what a harmonic pattern is, you'll be able to see. Let's share this screen real quick. All right. And here we go. We should be able to see this picture of the bearish bat on top. We got the bullish shark on the bottom. And these are a whole bunch of different patterns. The only one that's not on here, I believe, is the cipher pattern. And that's honestly one of my favorite patterns. But yeah, there's a whole bunch of different patterns. These are all complex pullbacks, but you can see they all have an impulsive move, an ABC wave, and then this is where you're supposed to trade from. You're trading from the D. So we have an XA, BC, D pattern. The two patterns that I like the most, I love the Gartley pattern. And like I said, I like the cipher pattern. Both of them, the D point ends at the 78.6. So I'm going to go into how to draw these or how to spot them yourself on the chart, and you know, just how they're getting these retracements. I'm going to show y'all how to get these, how they're getting these numbers. So let's go back into the charts. And in fact, let me show these patterns first. I want to show the Gartley, and then I want to show the cipher, just to show my favorite patterns for y'all. Let's go to the Gartley first. Now, the Gartley pattern has the impulsive move here. The pullback is to the 61.8. That's like the important part. The next move up is in between 38.2 and 88.6. And then the next move down is an extension of B to C in between 127 and 1618. You see all these fib levels right here are levels that I like to use, except the 38.2. But, and it's the opposite on the bearish Gartley, of course. But the 78.6 is from X to A. I'm going to show how to measure all of these in a second. Now, on the cipher, I like the cipher as well because it has very similar fib levels that line up. So we have an impulsive move, and then we have like a very nice ABC wave on its own, but then we get a deep pullback back into the 78.6 of the impulse. So I really like this pattern as well. Those are the only two that I really care to trade or look at. All the other ones, it's just, you got to pick your bread and butter, in my opinion. So let's get back onto the charts. I'm going to show exactly how you measure that if you're interested in learning how to draw your own harmonics or how to verify your own harmonics, really. So And then I'll go into the charts and show an example. So like I said, what you want to see first is you want to see an impulsive move to the upside. So let's do this, and let's call this an impulsive move up. Okay. Let's put that at like 14. Okay. So that creates the X to A. And let's make this over here in A. All right. Now, once the market starts to turn around, we're waiting for the market to turn around. Basically, I'm going to get these fibs out anyway. Template, harmonic fibs. Okay. Now the market's turning around and says it stops right here at the 61.8. Okay. Perfect. Now we have our B leg. This B leg is what is going to determine the harmonic. All the harmonics, like I said, start with, they start with an impulse. What differentiates them all is the B leg. So on that sheet that I sent out, or that I showed y'all that I can send out of all the different harmonics, they all have an impulse, but the retracement is what determines what harmonic is going to be what. So if this would have came to the 38.2, it would have not been a Gartley, which is what I'm going to show. It would have been, well, technically it could still be a Gartley. If it would have went past the 61.8, it wouldn't have been a Gartley. Okay, we'd be looking at a different pattern. So I'm going to keep it at the 61.8, and we're going to make another move up here, okay, to about, let's say, right here. Now, to determine if this is going to be a Gartley or not, we need to see in between a 61.8 to a 71.8 retracement of A to B. So then we fib this, A to B. Okay, now we have a 61.8 retracement. Boom. Okay, it can go up to the 78.6, but it can't pass it. If it passes it, it's not a Gartley anymore. Actually, it can stop at the 88.6, but it can't pass that. The numbers on that picture, they will, you need to keep those on, because it's like no point of necessarily memorizing them when you can just keep them in your keep them on a spreadsheet, in my opinion. So yeah, the Gartley is up to the 38 or the 88.6. It can't pass the 88.6. So we have it right here. And that confirms the Gartley is still intact. So the C leg was right here. Now, to find the D leg, I'll answer that question in a second, Tiffany. To find the D leg, what you're doing is you're measuring B to C. Okay? And the B to C is in between this zone. So this is where, because all this stuff, that's great. But to enter the market, this is where you're really looking for. So you're getting a zone from the 127 for a Gartley and the 1618. So this would be the buy zone from this extension down. And then you also want to look for the retracement of X to A, and you want it to hit the 78.6. So let's put a line at the 78.6. So that spot would be the perfect Gartley, to the T, perfect Gartley. Boom. And then the market would go up. So how would we trade this? Let me get into that in a second. Let me answer this question. So Tiffany asked, when you say it can't pass a certain level, do you mean it can't pass it, period? Or the candle can't close outside of that level? Perfect, perfect, perfect. So I'm going to be honest, putting Forex patterns into a box and then trying to put it on a shelf
and then trying to look at that and memorize that pattern. And if it does anything outside of that box, then exit out. That is tough. It really is. So to me, I let patterns be a little bit like, if there's a freaking crazy wick, but it's still like respecting this level, say this. Now, say this. If the market did this and left a wick way higher than A and then closed right here, no, that's invalid. That is invalid. A was broken completely. But let's say that I needed it to close below the 38.2 and it wicks up. Let's say it wicks up a little bit higher and then closes. That's still valid in my opinion. And here's another thing. Some people are super like have super strict rules. Some people are a little bit more risky, meaning their rules are a little bit more loose. So and another thing also that I've learned is certain brokers' price will be a little bit different as well. So in my opinion, if it does wick past it a little bit, it's not the worst thing in the world. I'm really looking for the close of the candle, to be honest, Tiffany. For me, I'm looking for the close of the candle. But if it's a huge, crazy wick that wicks way past it, I'm going to go ahead and just chalk that off, because on a lower time frame, that's not a wick most of the time. And I hope that makes sense. I know it was kind of on both sides of the question, but because it really is subjective to the trader. But for me, I kind of look at the close of the candle, and I'm looking for, a rule of thumb is 3% on either other side. So if it like hits the 61.8, give it a little bit, 60, 63, 64.8, that's okay. But like a little bit more than that, I wouldn't take it. I hope that makes sense. Now, to trade these, you're looking for, okay, the entry right here, of course. Let's bring this down again. Whoa. Let me get this in here. Okay. The entry is at the converging level of the D. Okay. And some people don't put limit orders. That's all good. You might miss it if you don't. But if you don't want to put a limit order, just wait for like a bullish rejection in this area. It's the PRZ, price reversal zone, possible reversal zone, whatever you want to call it. And then your stop loss, it truly should be below the X. Now, I know on some other patterns, X is broken, and that's why I like to trade these two patterns, the Gartley and the Cipher, because it gives me a stop loss. Some people put their stop loss at the 88.6. For me, I don't like that because it still could go down there. It's still part of the harmonic ratio. So like I said, I put my stop below the X, and then you want to target the C. So in this case, this would be almost a 3-to-1 ratio at the C point. That's your TP. So if you want to break it down, TP1, TP2, TP3, you can do that. This would be your TP3. Okay, that's how you trade harmonics. You want to put your TP at the C point, and your stop loss, that's really up to the trader, of course, always. For me, I put it below the X, and I'm only trading Gartleys and ciphers. So let's look at what a cipher would look like. All right. We'll keep the first move. We got a impulse move up, and I should have kept those. In fact, let's go. Bow, 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 bow. And we'll keep this here. So for a cipher pattern, you still got to get that impulse move up. So we're keeping that. Nothing's changing there. And then the retracement on a cipher is very similar to a Gartley. but it can go in between the 38.2 and the 61.8. So the Gartley, you want it to come down into the 61.8. It can wick it a little bit, right? But respect around this zone. For a cipher, it can stop at the 38.2, but it needs to get to the 38.2. So we have like a little zone right here for the first little spot for the cipher. Okay, and I'll just make it the yellow zone right here. And so for this example, I'm just going to put it at the 50 in the middle for us. And then that's our B. So that tells us at this point, when it comes to the 50, there's a whole bunch of different patterns it can be. Once price starts to make a move up and it breaks this high and holds, there's only two patterns it can be at this point, a shark or a cipher. All the other patterns make lower highs. Higher highs, shark or cipher. So I like the cipher. I don't care for the shark too much. So the cipher, we're looking for the C leg to stop between the 127 and the 141. So we have a zone right here. There's the 141 and the 127. We're looking for price to stop in there. Comes in here. Okay, beautiful. We have our C leg. All right. Now to find the D, that's where we're trading. Where's the D? All right. We're taking it from, well, let's figure it out first. So we're measuring B to C. So you got to do two measurements to find D every time. B to C, that first is going to be the 127 to the 2 extension. So I like to keep it at the 127 really. I don't like the 2 because it's always below the X. So I like to just highlight this area right here, the 127, okay? And then we're bringing out the fibs for the X to the A, and we're looking for the 78.6. Okay, perfect, right here. So like I said, this box is really supposed to be around this big for the ratio. But here is the perfect entry for the cipher right there, 78.6 of X to A. So that would be the area where I'd put the limit order. And you see we have an impulsive move, an A, B, C pattern, and then boom. This would look similar. This gives a little bit better risk to reward. So we have the stop loss below the X and the TP at the C. And you see we got a 4-to-1 right here on this one. So the reason why, like I said, I like these patterns the most, one, it gives you a defined stop loss below the X. Two, they both don't make lower lows for the D, so you don't have to worry about where your stop is going to be. I guess that's kind of the same thing. But they also, both of the B retracements can't go below 61.8. So it's just a little bit easier to remember. Okay. And yeah, that's pretty much it. I would say, oh, okay. Yeah. I got a question here. It's a good question. Maria, she asked if there's a best time frame to draw the fibs. The answer to that would be the higher the time frame, the stronger the fib level is, just like everything you ever hear in trading. But it's fractal, meaning you can trade fibs on any time frame. I said at the beginning of the training that I was using I was backtesting the 2-minute time frame fibs with some of my friends. Now, another thing I will say though, one of the most important parts of it is right here. Use it to measure an impulsive move only. If you start fibbing everything that you see, it's going to mess you up. So you really want to wait for actual impulsive moves, not just break and retest. I mean impulsive moves. How I validate an impulse is I use MACD. If the MACD makes a new high, then that's a pretty good validation for me. Now I did want to show some examples of harmonics. I'm going to go over to the crypto market because this is just where I have it off top pretty much, where some were. This one, by far, I'll never forget this in my life. It's one of the times where I first started really getting invested into the crypto market. We were down here at 3,000. And this is when I kind of fell in love with the Gartley pattern. And price came down here and created a very, very nice Gartley. So you can see after it being very low for a very long time, or it made like this impulse down here. It was chilling down here for a minute. It made a big impulse, and it's really a 4-hour setup. So if I went to the 4-hour, you'd be able to see the validation of this. Okay, so you see you got that big impulsive move. So I have my MACD on. Let's bring it out. Okay, boom. We got an impulse, big impulse, right? So we take this and we get that first impulsive move right here. Boom. Then we got a deep pullback, almost to 61.8. And then we get a retracement below the 88.6. That's key. Now we're looking for a 78.6. And we got it right here. So the 78.6 got hit here. Would have been a little drawdown, and then you would have caught the biggest move in history. Not history, because there's made a big one before. But here's an example of what it looks like in a bullish market. So we're trending, big trend, right? Big trend. This harmonic barely missed. So we had an impulsive move here. Okay, we got a pullback. We got to push up. We're looking for a Gartley. We're looking for a cipher. So the 78.6 would have been right here for a Gartley. For a cipher. That didn't happen. It didn't make anything, and it just pushed up. But then another pattern happened, and this happened on the daily. So there was a very big impulsive move. We had a correction to the 61.8, a little bit deeper than 61, and this is in the case where, if you want to use the close of the candle, you can. And we get underneath 88.6, so we're looking for the Gartley. When it comes to the 78.6, very close, so 78 would have been here. But see, this example, it's very close. So like I said, around 3 pips, I would allow 3 pips or 3 points on this above and below for your validation. And then we get, reaction here, move up. We got a couple smaller ones down here. Those would be like 1 hour or 15-minute patterns. So another thing, the more candles you have in between your harmonics, the stronger they are. So you see how this 4-hour, it is still a 4-hour harmonics, the cipher. You see how this didn't necessarily play out compared to, that other one. This one super played out, almost to the C, right? So, I got a couple over here on Ethereum as well that we can look at. But that's pretty much it, guys. Ethereum's kind of in one right now that could possibly start to turn to the upside. That's a cipher pattern, by the way. We have a Gartley right here. A Gartley pattern right here that formed below the 88.6 here, and then we came almost to the 78 here. Boom. But yeah, if y'all got any more questions, let me know. What do you mean using the MACD? Can you show us? Oh yeah, so yeah, the MACD. Everyone uses different indicators, right? So if you use the RSI and you see an impulsive move, that's how you kind of know um, when you're getting a true impulse. You should see it in structure. You should see it in the candles as well, right? Like this right here was a big impulsive move. So you can do this, you can do this, and then, oh, we get a cipher set up, but nothing came from the cipher. D never happened. This was your confirmation that that was an impulse, right? That's how I use that. I've kind of done some other trainings on the MACD. I don't want to get too far into that. But basically, I just wanted to show the basics of the harmonic. You want to wait for an impulse. You want to wait for an ABC wave, and then you're looking for another move up. It's pretty simple. Don't have to look at it too hard. Of course, you can memorize the ratios to validate what you're looking at, really. But if you see an impulse, an ABC wave, it's going to most likely give you a correction. But that's it for me today, guys, unless we got some more questions. I appreciate everyone for getting on the training. That was fun. I hope you learned some stuff. And, you know, make sure you don't take trading too serious. Have some fun with it. Find your setup. Get good at it. And, yeah, I appreciate everyone for coming on. And if you did learn something, please send me a message on a DM on Telegram. I want to know that I'm helping y'all out so I can provide more value. So I'm going to do an analysis tonight, yes, at 9 p.m. Central Standard Time. So, yeah, I'll be posting this on YouTube as well. So if y'all could go on there, smash that like button. I appreciate it. All right. Yeah, y'all have a good one. Make sure you tell your friends you miss them. Go ahead and just text them right now. Miss you, bro. Miss you, girl. And go ahead and just text your mom and dad. Love you. Then think about you. Y'all have a good one. Peace out.